I'll record and I'll do a quick run. Okay, now let me share back my screen. Okay. All right. So for the interest of the recording, I mentioned about how we envisage your growth path. At the end of this whole journey, we expect you to have a demonstrated strategy. You should have a justified capital need. The efficient due diligence, documentation should be in order. And ideally, the approach you are taking is not as risky as it would ideally be, okay? Because you've received the guidance needed, okay? Yeah. And I mentioned one of the key challenges with the investors on our financials and our management systems, they don't like the fact that some of us do not prioritize right, or we do not, when we ask, okay, what do you need the money for? The use of the money does not depict appropriate priorities or appropriate use of the money or appropriate efficient use of the money. And then how this money is managed within, okay? Do you keep the money in the bank or do you just keep in your card drawer? You know, there are some things, okay? So those are some of the things that you need to pay attention to. As we try to prepare you to look good, also internally try and ensure that you look okay, because it will be doing us a disservice when you pitch, you get financing, and we have some amazing investors participating from here, from Kenya, and from outside. And then you present, they say, we are very interested. And they say, okay, send us this, and you don't have anything. Okay, so start working backwards for those ones who don't have. Okay, and I told you, the way we are going to approach financial modeling is to help you, one, evaluate your decisions. Insourcing, outsourcing, should I do it internally or externally? I'm not saying you should do everything internally or externally, but you need to review based on the level and the stage that you are, okay? Sometimes outsourcing is costly, but sometimes it is the most efficient and quality measure to put in place, okay? For example, if I am in the printing business, printing and these people of branding, I can decide to buy machines to be printing. That means I'll have to be maintaining the printers. And you know, these machines keep on improving just the same way phones and cameras. And you find somebody now is printing much better quality because the machines depreciate. But I don't print probably every day in the same quantity. What if I always identify the best and most efficient machine in NASA Road to be printing for me? Okay, so that's just an example. Buying versus leasing. You need land for a factory in Naman. Should you buy or should you lease in the short term? Buying may cost you 500 million before you even start buying machinery or whatever. And leasing could cost you 50 million and you actually buy machinery and have things moving. Which is the most appropriate decision as at now? These are decisions you need to make. Investment versus acquisition. Should I acquire? Should I acquire a factory that is doing this, or should I start? I want to start a dairy factory. Should you start it from scratch, or should you acquire one that maybe the owner has reached a point where he feels, you know, I need to move? And by there, we have actually a partnership with a business that just focuses on promoting and selling businesses. And then credit analysis. When we do the financials, you should be able to know. And I think I showed you out of rule of thumb, the maximum amount of money, if it is debt, that you can be able to ask for. Look at your monthly revenue. Okay. Revenue. This is just a rule of thumb. It's not fixed or cast in stone, but I'm giving you generally. This is what we expect generally when it comes to you asking. Your monthly revenue multiplied by 12, okay? You multiply it times 150%, okay? That should be able to give you the fair amount where you should be asking if it is debt or a loan. If you are doing below, don't ask for more, because even if you are to be given, it will still be low because they'll be negotiated on the lower side, okay? If it is equity, it can go higher, but also you need to manage the amount of money. I hope that gives you an idea. All right. Okay, let's proceed. As I said, we are going to work on financial forecasts, and I'm going to focus on two techniques simply because there are those of you maybe who already have financial statements, they have accountants who put for them their records. There we shall be very happy and we shall probably use this to project. For those who may not be sure, yeah, we shall try and use top-down, which makes a few assumptions, but I hope it can be able to give a little bit of perspective on the numbers. Okay. Yeah, right. Let me clear this, sorry. Any questions so far? I hope I'm challenging a little bit of your thought processes. Now, when we go into projecting or budgeting, there are a few things we look at, okay? You will find many people saying, oh, this year I made 10 million, now next year we shall make 50. When you say you'll be making 50, there are some new things we shall be looking at. Has your marketing spend changed? Your budget of marketing, has it changed? How can your sales increase when your marketing spend has not? Is it that there is a new way you are doing it that is uniquely different? Then are there new initiatives? Maybe there is a factory, maybe you have acquired. Are there new initiatives? Maybe you're acquiring a machine or you're expanding or whatever. What are those new initiatives? Then we shall also look at your competition. Is it that, for example, Airtel has exited, so the market has increased? Or is it that you found a new market, or the market has changed so that you are better placed to acquire the market? Okay, so these are some of the things that we base on when we look at new projecting. Okay. Now we are now moving into the things that I enjoy. So for those ones, whether you know your numbers or you don't know, the one thing that I'll at least want you to know is the market. The market, it may not be the market here, but the market. For example, we did our business modeling, and you had the what we call target customer. Target customer or market segment according to your plans. And in it, you said, I'm going to target schools. And then you said you're also going to target maybe hospitals. Okay. Now I'm just discussing markets and how the numbers come. Now, you said in 3 years, you expect to get maybe 200 schools, and hospitals, maybe you expect to get maybe 100 schools. Now, out of each school, okay, now I'm just on markets. Okay, each school in a year orders 1,000 kilos per year. And each hospital orders maybe 2,000, okay, let's say 5,000 kgs per year. Okay, I hope you are going to see how basic projections come through. So I'm targeting to get 200 schools by my 3rd year, if your business plan is 3 years, or by 5 years. Okay, now, or 100 hospitals in 3 or 5, depending on how your plan is. Now, this just highlights the market. Then all I'm going to add is I'm going to say, okay, so 200 schools buying 100 kilos. What am I going to sell each kilo at? So I may say each kilo or each, so I'm going now on the second attribute, which is price. And I'll say maybe the price of each kilo is 3,000 shillings. I don't know, we put behind or in front. GX per kilo. Okay. I hope you are now starting to enjoy some numbers here already. We've not started, we are just warming up. Okay, and say 3,000 kg. Ladies and gentlemen, I've almost finished financials with such an introduction. So ideally, this will be able to tell us if, okay, if I do 200 times 1,000, those ones who have calculators can help me. Just this here, we are doing basic logical computation as I introduce you into the numbers. And this one, and in this, I'm just trying to do top down. So 200 times 1,000 times 3,000. That comes to how much? That is 6. How many zeros do we have? 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. Okay. So this is already an approximation of the expected revenue by the time I get this market. Okay. Hospitals, if I get 100, I will still do the same. This is 5 times 3, that is 15. Then I get the zeros 1, 2, 3, 4, 5, 6, 7, 8. Okay. 1, 2, 3. Sorry. Oh. 1, 2, 3, 4, 5, 6, 7, 8. I hope that is 8. 8, yes. Okay. I put my separators. Okay. So, in simple terms, just by this, the first 2 attributes, I can easily tell my revenue. All I'll need to say, okay, in year 1, maybe I'll have 50. Then year 2, I'll have 150 schools. Then year 3, I'll have 200. Okay. But ideally, I can now bring down the revenue. Then I can look at, okay, if I sell a kilo at 3,000, what is the cost I incur per kilo? So the cost comes into, I'll do the same schools. How much? So this is 200 times, there are 1,000 kilos they buy in a year. And I say maybe I spend for each kilo, I spend 1,000. Let me use numbers that are simple for me for now. 1,000 per kilo EGX per kg. Okay, that will give me 200 if I'm not wrong. Okay, hospitals the same. That is 1,000. That's 100 times 1 times 5,000 kg per year times EGX. Maybe for hospitals I spend 2,000 per kilo, depending on the engagement. So that comes to 10. What was this? Yeah, that comes to about a billion, if I'm not wrong. Yeah. Well, as you can see, just out of these 3 attributes, if I know the market in terms of how much they're going to consume, the price and cost, I've basically summarized, and I can easily say, if I total this up, okay, and I total here down, okay, I can easily say this is going to be, this is going to be 2.1, if I'm not, yeah, 2.1 billion, 2.1. And this is going to be 1.2. 1.2. So this gives you, you can say this is gross profit of 900. Now, what I'm just sharing forms the basic principles of unit economics. As long as you know your unit cost, how much do I gain per unit? How much do I spend per unit? That is good enough, okay? And I'm going to, again, use another example differently. And does anybody have a question? I'm just giving initial logic or foundational logic, how all this emanates from. And if anybody has a question or lost, feel free to ask. We've not gone deep. We are just introducing basic precepts in this, okay? And this forms the basic of financing. Know your price, know your cost. If you know your price and cost, then you can know the outcomes of so many other things. So because I have, I'm going to base on the assumption that most of us, okay, not most, some of us do not have records and they need to work backwards. For them, I'll guide them from the unit economics perspective using the top down. And this brings the top down. It comes with the market, price, cost, and based on that, I can easily generate and then extrapolate. Extrapolate is now expanded years behind, years forward. And I finish my statement. So I'll give you an example on Excel, but this is introductory in terms of this. Is it clear? Please show me a thumb just in case it's a concept worth your attention. Anybody lost? Okay, Susan, thank you. The others are lost. Rona, are we together? Oh, thank you. Sheila, are we making some digital financial sense? So these are basics and anybody can do that, whether it's the lady in the market or border guy or whoever. These are basics, just basics. We've not gone into typical accounting. Nicholas, oh, is that a signal or a question? Okay, I assume it's a signal. All right, so ladies and gentlemen, the one thing I don't want you to forget, market, price, cost. You may not know the market share, that one, but know the volumes. How much does this, okay, if I target women, corporate women, how much does each woman buy in average in a month? Okay, they buy at least once every quarter or every month. How much do they spend on this product on average? Sorry, I could have been lost. I hope I'm back. Sorry, I hope I'm back. Yeah, how much do they spend on my product? Then what do I spend on the product? Just that, those three attributes, my dear friends, you can articulate your numbers. So I hope you are now embracing this. This is not your typical accounting. We are moving from the corporate side. Okay, so we know we do financial forecasting so that we can make better decisions, prepare to present our financials for accounting, for funding decision. So we need to be able to make these financials. Okay, financials preferably we use history to make projections. We use the past to project the future. Okay, and the most common statements that you need to be aware of are income statement or profit and loss, balance sheet, and cash flow. Okay, now we are going to go into now basic fundamentals, and now you'll understand the reason why I asked buying versus leasing, insourcing versus outsourcing. All those decisions start with these key things. fixed costs versus variable costs. Does anybody know what a fixed cost is? But now I've already showed you. But anyway, I don't mind showing and then asking. Can somebody tell me, even if you have seen, what is a fixed cost, what is a variable cost? So that, and you are going to realize that once you understand those two costs, so many things you'll see a lighting bulb in your mind in terms of how you prioritize. Okay? What is a fixed cost? What is a variable cost? Anybody? I even shared it on my screen. Godfrey, please tell us, what is a fixed cost? What is a variable cost?
Yeah, thank you, Roy. According to my understanding, fixed costs are those costs that are there no matter, even if you're doing business or you're not doing business, no matter how much you produce. For example, rent. Where you're renting, it doesn't matter. Even if you're producing 1,000 products or one electricity, the more I use the machine, maybe the more electricity I consume. The raw material, the more I produce, the raw material that I use. So for me, that's how I understand it.
Thank you, Godfrey. Ladies and gentlemen, if there is one thing I want you to learn from the Pitch First program, okay? Even if you don't understand financials in the end, which I believe you will do. I have trained people in the village who just know 1 + 1 and they have mastered numbers. So I expect you to be even on a different level. But I want you to understand the importance of this fixed costs and variable costs. Fixed costs are independent of output. And they arise with 0 level of output. For example, if I have a warehouse, I am renting. Whether I have goods stored or not, I will incur the rent. If I have a distribution vehicle, whether I am distributing or not, okay, I still have to maintain it. Variable costs are dependent on the output. For example, raw materials. The raw materials I have contribute to the finished product. If I have less, I'll produce less. If I have more, I'll produce more. Okay? And so many others. We are going to see the examples. And as you can see this graph, okay? Fixed costs and variable costs. You will realize one thing. We have been navigating the pandemic, the COVID pandemic. And you'll realize most companies that had more fixed costs are the ones who are deeply affected to the point of closure. Those ones who had more of variable costs survived and in some cases even thrived because they could easily adapt or adjust. That is one of the reasons I'm sharing. Safe border and the border borders. The fact that they are not owning the border borders as a fixed cost and the people who ride the border borders as a fixed cost, the border borders and the hiring or booking becomes a variable cost. So they only incur and they only earn based on use. That makes it a variable cost. Those ones who had offices during the lockdown of 6 months in town, Mujaja Mall, wherever, where without your presence, you do not sell. Okay, without your location. There are those who made it, WhatsApp, on order, I deliver. Okay, fixed variable costs. Ladies and gentlemen, that forms the basis of everything I was explaining to you earlier. Buying versus leasing. Acquisition versus initiating. All this, and you will notice, depending on the priorities, the cost varies or the cost does not vary. All right. If there are any questions, feel free to ask. I'm going deep into the same logic. Now, you are going to see, as you can see here, variable cost vary with change depending on production, while fixed costs do not change depending on production. For those ones who are in service, production means you are delivering, whether you are delivering as a training or whatever. Okay, I can have a consultant full-time training, or I can have a consultant as and when training exists. One side is fixed, one side is variable. I can have an accountant in my salary, or I can have an accountant 4 times a month. So every week they come and validate. One is fixed, one is variable. I hope you see the difference. Now, when variable cost, the cost increases with production. Fixed, it is fixed, whether increase or reduce. And you can see examples here. For example, production supplies, raw materials. These are variable costs. Direct labor. So if I'm paying people per production, you can have people, they work for you 24 hours and they have not produced and you pay. But there are those who work, for every bag you produce, I'll give you 200 shillings. So the man has to motivate himself, whether he works overtime or whatever, it's a variable cost on production. While this side, I'll be paying you 200,000. So it may look like you are saving, but you may find you actually losing productivity. These are some of the things that you need to evaluate. And hopefully, I'm changing your thought process of prioritization. Okay? Wear and tear is a variable cost. Delivery, okay? Jumia, you people know Jumia. Jumia is just a platform. It sells from existing providers and whatever, and delivers. So the delivery cost is incurred by when somebody buys, they get their commission, they tell whoever, Roy, supply this, they supply. So for them, the entire business is based on a variable cost. They only have few fixed costs, that is salary of the key management, strategic people who handle the advertising. And that's why they can spend $10,000 a day just to market. But you see, they don't have a lot of fixed costs, okay? So their visibility is high because of that, okay? While fixed cost, rent, advertising, if you've put it as a budget, insurance, depreciation, expenditure on machinery, whether if you buy your machine, okay, it is a fixed cost, okay? It is not a bad thing. The question is, based on where you are, do you need a machine, or you can outsource? Then when you are in a position, then you just buy an efficient machine. And the other thing, I was actually sharing with an entrepreneur this morning who wants to scale up and buy a mill, have a milling plant and whatever. We've seen entrepreneurs who they're making 5 million. He wakes up, he wants a very big machine, and we go and fabricate. What we don't know with machine, you need to look at the power efficiency and productivity. I just want you to know, for those ones who may not know, some of the people milling, you find an entrepreneur making 70 million, but he spends 50 million on electricity because they fabricated without knowledge of efficiency and use and productivity. So you find as much as they are producing, they're actually eating the money they are producing, okay? And this all comes out into, did you have appropriate knowledge on choice and use of the equipment that you're buying? So one of the things I advised him, fortunately worked with a technical person, and I asked him, go and review the machines, the efficiency of power production, etc., so that you can get the best optimal machine based on his next level of growth. Okay. I hope you are seeing the relevance of this and applicability of this. All right. Yeah. Now somebody mentioned break even. Today you are going to do break even because it comes from this logic. Okay. I'm seeing a comment here. Is there a question? I have tried to use variable costs in all areas of my operations, but in some areas I have really failed. Dennis, you don't have to apply variable costs everywhere. It is dependent on what you do. And sometimes you have to control, and to control, sometimes you have to have those costs fixed. Okay. And you also have to learn, depending on the environment, the people you work with, is it better to have fixed or variable? Okay. So in many cases, it varies. I would recommend it's based on situation, circumstance, people, process. Okay. So there is no fixed formula for that. It has to be dependent on a number of different factors. The only thing is, you will realize that you can manage quality and productivity when it comes to variable costs. In some cases, you have people who come, for example, you've employed a sales team, and they come to office and sleep. At the end of the day, you still pay a salary. But when you put it as a variable cost, say maybe I will facilitate you 50K, but for each sale, you'll get a commission of 10%. My dear, sales will, because if you are not producing, then why should we pay? Then you'd rather get, you see, these are factors that come into play. Are we together? So I hope you are now getting a little bit of logic and strategy. We are sort of throwing one stone to 10 birds at one hit. Okay? All right. I hope Dennis have answered you. Okay, so let's look at break-even. Break-even point. Break-even point. Break-even point. For those, since you are going to pitch, we need to know your break-even point. What is your break-even point? Your break-even point is when your revenue and your costs meet. When your revenue and costs meet, that is your break-even point. Okay, and why do we use this break-even analysis? It helps us determine so many things. By the way, just this unit, when you can articulate this in front of it, they say this is a smart entrepreneur. They know what they are doing. You already know now what fixed cost is, what a variable cost is, and now we're going to break-even point. Okay, and break-even point is, for example, if you borrowed or you got a loan of 200 million, usually you'll be asked, so when will you break even? Break even is when we shall achieve the 200 mark. Or if there is a interest again of 50 million, then you can as well say, you can add the 50 on the 200 and the break even becomes that time. So let's go on an example. You know, sometimes you need to explain with the numbers. You need to explain with the numbers. For those ones who have pens, you can write or whatever, but I'm just teaching you logic. We shall have an Excel which has all these formulas in it, put in. All you need to do is put the numbers, but I'm trying to give you the logic. Okay, so for you to calculate break even, you need to know, one, your fixed costs. You need to know your price, and you need to know your variable cost per unit. That's all you need, and you'll know your break even point. Okay, and your break even point, how do I really want to simplify. Let's use an example so that it's easier for everybody. So let's look at this use case. If a company requires a profit of $30,000 instead of break even, the 30,000 should be combined in the fixed expenses in order to compute the point at which the company will earn break even. Now, this is not an example. I'm going to use one of your examples. So let me create a case here that should be able to be familiar. So I'm going to say, oh, sorry, I have to pick text. Sorry, text. Okay, so let's say, I'm going to say a Kenny company. It sells let's say maize flour. I think that's the spelling. Hope I did my English class well. So, and the price of this flour is, I think maize flour is about 25. I'm not sure. 25 UGX. Huh? UGX. Okay, which is the price. Okay, so we put here the price is this. Okay, because you know variable costs now you can count and say, okay, I pay for each staff who works in my production and whatever, all costs that you incur in production, you can say I spend 10 million, and in 10 million I produce 30 million worth of maize flour. So if I divide, it will come to, my variable cost will be 3 million. So I can say the cost of UGX is 3 million. I mean 3K. Okay. And then what else? So that is my variable cost. Then I'm also going to look at the fixed cost. So for example, a Kenny needs how much? Needs, I want to use a simple number, 10 million. He needs 10 million. 10 million cash. Yeah? Needs 10 million. Okay. So the 10 million we categorize it as fixed because it's a fixed amount he needs. When you say funding request, 200 million, it's a fixed amount you need it. So it's, we call it a fixed because you are going to inject it. That fixed amount, you are going to inject it in the company. So we'll take the 10 million, okay? So I'm just going to take the 10 M. 10. Okay, so my break-even point, sorry, the 10 million. So you can put it in your context, the amount of money asked, the 10 million divided by my price, which is 3.5, 3,500 minus the variable cost, which is 3. Okay, this is equals. I hope this mathematics is very simple. We are not complicating things at all at this point in time. So this comes to 10 million divided by 500. What does this come to? 10 million divided by 500, that comes to 2. 1, 2, 3, 4. So that means, I think that is, yeah, I'm not sure. That should be 20,000 units of, so units, we said it's a kilo, so kilograms of maize flour. So we can just look at the company's operation and say, if on a day you produce 200, if in a day, maybe you do 200 kilograms, you just divide and say, okay, that will be equivalent to the 200 kilograms, I mean 20,000 divided by 200. And that will give us how much? 100 days. So in other words, Mr. Akeni will break even in 100 days. So he can easily ask and say, you know what, I need 10 million shillings. I should be able to break even in 4 months. And beyond that, I'll be making profit. Does somebody have a question on break-even? I don't know if I've made it complicated or simple, but I'm happy to do another example, but I'm also happy to answer questions. Now, don't worry about these calculations. We have inscribed some formulas, so you don't need to cram how this comes about. I just wanted to bring out the logic. Godfrey, question, ask.
Yes, Roy, how are you? Now, how about these companies of ours that have...
You have million products.
Have different selling prices for different products. Perhaps you're even doing exports where you your profit is in volume. So it's a cocktail of stuff. But the money you want is coming in the company. It is going to contribute to each of those.
All right, that's a good question. That leads me to the next point. If I don't answer it in the next point, then you can ask it again, since you have brought the point of variable. So you've just seen an example of break-even point, and the application of this for the amount of money you are asking. That amount is equivalent to a fixed cost because you are asking a fixed amount. Okay, so we need to divide it by the price or the weighted price. Now, for example, for Godfrey, we can calculate a weighted price and we can calculate a weighted variable cost. Okay, that is one angle. The other angle is we can use your income statement, but that one I'm going to show you a bit later. I just want us to simplify this. I don't want to make it complicated where somebody gets lost. Okay. All right. So let's go to the next. This is a company that is doing juice. It is doing juice and it has 3 varieties of juice. And it sells pineapple juice at 3K, passion juice at 3,500, cocktail juice at 4,000. And it spends, okay, the fruits and the amount of money they pay the people who make. For the pineapple juice, they spend 500 per liter of the juice. For passion juice, they spend 600. For cocktail, they spend 700. Okay. Now, for us to be able to compute the break even, we need to simplify that mathematics, we need to know the weighted average price and the weighted average, the weighted average variable cost. And how do you do it? We just look at the amount of money each of them contribute. So for example, if I make 5.5 million, and you will find that out of this 5.5 million, 50% of that amount came from pineapple juice, 30% came from passion juice, and 20% came from cocktail. So I have to see the amount of which each product contributes. And this comes back to Godfrey. One of the things investors don't like is you invest in everything and you actually find it's only 3 products that are actually contributing to the money. I've seen investors where they say, I don't want our money spent on this product or this. I want it only focused on this because as far as we are concerned, this is where the money is coming from. So be cautious a bit about it. So for you to be able to compute, and this is for those ones who are making products or selling products, that there are more than 1, but not more than maybe 10. If there are 2 variable, there are also other ways in which we can go about it. So there you can compute weighted, okay? We can standardize the price and we can standardize the cost by just looking at, okay, pineapple juice contributes 50% of the money we make. Passion juice contributes 30% of the money we make. Cocktail juice contributes 20% of the money we make. So all I'll do is I'll standardize by, how do we standardize? Let me just show you how the numbers down came about, because and you don't need to master this, guys. We have formulas that do that. So I'm just showing you, but you don't need to say now I'm into a new mathematics class. This is how we get the weighted average and weighted price. That will be equal to, I'll take the 300, let me just expand this. So I'll take the 3K times 50%. You know what 50%, it means 50 over 100 plus 35 times 30% plus 4,000, so in brackets. Don't forget the basic principles of mathematics, body of mass. And that will give us the weighted or average, the weighted price, which comes to 3,350. Now you see, with that number simplified, you can use that and say the average the average price I sell my products is 3,350. That does not mean all your products go for 350. It just means that you've already standardized. There is a higher price, there is a lower price. And then the variable cost, our average variable cost is around 570. So cost the same. This was price. Okay, that's how we come about it. Weighted costs, just the same logic, my dear colleagues. I'll put it in brackets, 500 times the 50% it contributes, plus 600 times the 30% it contributes, plus 700 times the 20% it contributes. So 20%, right? And that should give us 570. Now, you've simplified the technical and say, oh, I have Bijanjaro, I have maize, I have soya, I have what you say, I sell grains. The average price is 3,350 and my average cost is 570. So I make an average margin of about 2,800. That you've simplified the logic and anybody, even a 5-year-old will understand. There is business there, there is money in that person, we need to give him money. Because we don't want to go into, oh, maize, we make profit of 30%. Beans, we make 20. This can be harmonized. I hope you are seeing that logic. And this is where we do that. Once you do that, ladies and gentlemen, and as you can see, in this table, the weighted costs are there. All you need to do to calculate the break-even, the example is there. You just take the amount of money, whether it's the revenue or if you needed a loan of 10 million, 20 million, you pick that number and just the same process, that's 5.5 million, 5.5 million, divide by the price, which is, which we have harmonized, so the number is easier. We have made mathematics very easy, and you divide. And that will give you the number of liters you need to produce. Now that is general, that is general, the entire liters. Now you can now break down the liters and say, okay, since pineapple contributes 50%, so I can easily say, so for pineapple, since my break-even liters is 178, so for pineapple, I need to produce this number of liters. So that also helps you balance, because sometimes people need more of pineapple juice, and for you, you are focusing on cocktail juice. This break-even helps you prioritize on which product you need to prioritize. Some of you have stock of things customers don't need, and you focus less on things that customers need. This is where we solve this problem, ladies and gentlemen. So here you will calculate the break-even liters, and you multiply by the contribution revenue. So 1978.4 multiplied by it's 50%. Then for passion, the same. The liter, the break-even point, times its contribution, which is 30%. Then cocktail times its contribution times 20%. And you get to realize that now for pineapple juice, you should be making 9,089.2 liters. Passion, 593.52 liters. Cocktail, now there you will find your optimal and your profitable and your strategic. Godfrey, please ask your question. I don't know if I've answered or I have confused you or I've helped. Please feel free to come in. And I hope for those ones who had expectation on break-even, have you checked that we are solving the break-even or we have not? At this point, I would like any questions on break-even point. But I hope I've simplified to the best of what I thought. And you are going to see where this leads us to. Any questions on break-even? Anybody have a question? Do you see how it applies in our day-to-day business, where some people focus on the wrong things, they buy things that delay money and less on things that actually allow money? And you can see just out of that logic, a lot of things, a lot of processes, a lot of decisions can be made around our business. I can decide to create a branch or franchise. One is fixed, one is variable. I hope you are seeing. I can scale in a day, or I can scale in 10 years, just out of the logic, fixed, variable. Should I do it? Should I make it as a variable and make things happen? Any questions? Or you want to give me a thumbs up? Please give me a thumbs up if you're happy with what you've understood. If you've not understood, you put a thumbs down. We shall. But a thumbs down will be like, what have I been doing? Have I been wasting time with these people? Does it give you some insights, ladies and gentlemen? Does it give you insights, logic? Yeah. All right. So I'm going to finish this juncture. No, we are not finishing. We are just beginning. But for this, I want all of you now to see where it leads us to. Hey, Susan, please ask where you've not understood. I don't want to move when somebody's behind. Please ask, where didn't you understand? And anybody, please ask so that you can be guided. It is for your own personal. You came in alone. So ask, no matter how stupid you think the question may be, please do ask. When you ask, you are guided. Please ask. Susan, over to you.
Just give me a brief. I've understood, but not so well. So just a brief of what you meant by the whole thing, especially when it comes to the equation.
The equation is not really for I don't want you to cram the equation. I want you to understand what it brings out. Because the equation, those are things that we can apply in Excel, and you'll notice there's a sheet that we shall share where you can just feed in. So if it is the equation, don't really worry about it. But if it is the logic or applicability, I'm happy to guide. Which is it? And when you say everything, it's a bit I can focus. So you need to guide me a bit where you want me to emphasize on.
As in the applicability of the equation.
Okay, so the applicability, if you have 10 products, you've seen people who have 10 products, they're selling, some have 20 products. And sometimes they don't know where they need to actually. Okay, sometimes they go seeking money. I want to set up a factory to do milling when I'm making more money in raw maize. That could be the case. For example, the product will change. Raw maize is 3K. Then milled maize contributes 20%. So you may realize that I'd rather outsource this milling because it's contributing less and continue the raw because it's contributing higher. Like based on what each product contributes to my revenue, then I can make the appropriate steps on what I need to do. All right? So, I've seen entrepreneurs with 6 products, and you find 3 products generate almost 90% of the money. The others, because they are emotional about the product, but it's not a product the market really appreciates. Usually, investors sometimes, when they get that as an insight, they may even say, you know what, we don't want our money in this thing. This one is your own business. Our money should be focused on these things. Are we together? So the emphasis is prioritization and decision-making and the strategy. And by the way, this is the basic level of strategy for an entrepreneur. As long as you have just the basic insights in terms of costing, it also guides you on price. you'll realize that if you increase your price, it can influence how fast you get to your break-even point. Okay, but I'm emphasizing this, the fixed cost, variable costs, also because when you pitch, the list we would need you to articulate is, you know what, if you are doing several things, or it's like a shop, which you have several products, it's a bit tricky to say, my price is this and my variable cost is this, but you can easily say, you know what, I make an average of 25% profit margin on each product. Okay, that makes sense, like an e-commerce that can apply. But if you are doing products, I'm making phones, we need, what is my price? What is my cost? What is my margin per unit? Then now when it comes to strategy, you can look at volume. Now, in some cases, if you want to set up, say, a manufacturing plant, maybe your price is 200K, your cost is 150, but if you set up the plant, your cost will reduce and you can still maintain the price, so your profitability will increase, just out of one single logic. I saw, Susan, have I answered, or have, I don't know if I've made it better.
Yes, Roy.
Yes, sir.
Roy, I think the same, I was just trying.
Yes, sir.
Cosmetic products.
Yes.
And so I think to be able to come back to that point of saying maybe the break even is much easier for people who you have already hinted on it. If someone is dealing with
Sorry, Alex, it looks like the network is really
shop. Well, how do you, that's what my friend Susan.
Yeah, thank you, Alex. We can approach it a little differently, and that is where I'm going, but you'll see that there's a relationship. So, for example, if you're dealing in a shop, price generates revenue, eh? Okay? Then you incur costs, okay? And then you also have gross profit margin. Now, I can use that to compute, but a little bit with the same insights in mind. For purposes and interest of the rest, for those ones who have, what is it, the shop or whatever, I can guide you with some insights. But if you want to articulate, say, the units, what is accepted for you is, for you in particular, is we shall need to look at your segment. So I'll say I'm targeting maybe women, pregnant women. I'm targeting, okay, let's say pregnant women, or sorry, respectful word is expectant women. And on average, it spends on my pharmacy an average of 50,000 in a month, okay? And I make a margin of 20% out of the product. So for that particular context, we bring the unit economics a little bit from a different dimension. We bring it from the customer side, from the margin side, from the spend. What is the average spend? So that also brings out that you have insights about how your business works well. Okay, and yes, you may have other customers, but few under different segments. Sorry. Okay, you may have customers under different segments, but you can again weigh and say, okay, on average, yes, there are those who spend 100K, there are those who spend 20K, but the median spend is about the median spend is about 70K. So I'll say on average, each customer spends about 70,000. All right. Alex, I don't know if I've clarified a bit. All right, but we are moving systematically. Just follow the flow and you'll see. What I want you to do is to pay attention on the units and the things that can make you look good in understanding your business and things that will make you be appreciated to be somebody who understands how your business works, your costs, your revenue, your margins. And when you say, I now want to set up a branch or I want to do A, B, C, D, somebody will understand that that is a very informed strategy. It's not coming out of the blue. You've done your numbers and you know, okay, for each branch I increase, we're increasing the revenue by at least 50%. And you know, so it allows you to be able to articulate your business well. And that is the main aim why I've started from the foundational areas, okay, of this discussion. All right. We're going to take a short break after this slide. So you'll realize that eventually we are able to bring out that from the price we make sales. Price times volume is sales. Eh? Just to be very direct. Price times volume is, yeah, price times volume sold is sales. Eh? Okay, and the cost, if I take this costs times cost incurred times the volume sold will give us the cost we spent on the things we sold. So that can give us contribution margin. And now to answer Alex's question, you will realize that based on the contribution margin or gross margin, I can still be able to compute your break-even point, because from the same logic, the contribution margin, or in some cases, there's a very thin difference between the contribution margin and the gross margin, because contribution margin does not have fixed variable expenses, while gross margin has fixed variable, but nonetheless, all of them are variable expenses. So when you take the contribution margin or the gross margin, okay, divide by, you are basically, so what I'm trying to tell you, Alex, when you look at your margin or your profit, divide by the amount of money you have asked, you should be able to get your break even. I hope that makes sense. So the same logic, it's just that we shall apply it differently. I hope that gives you an insight on that. Eh? So you just take the gross margin, divide by the amount of money you've asked. So if I've asked for 200M, I can take my margin and divide it by the amount of ask. That should be able to give us an idea of when it will take for us to break even. So if it is your monthly margin or your annual margin, then you should be able to have an idea when you'll be able to break even. And this informs a lot on the decisions of finance. Okay, so maybe let me ask, we take just a 10-minute break as we digest or maybe capture a few notes, and then we shall proceed from here. At exactly, sorry, it's an 8-minute break. So at exactly 11:10, I will proceed and go a bit deeper when it comes to applying some of these numbers. So I'm going to use a few templates, and eventually you will advise which templates you want me to send you. But because I'm trying to simplify, I'm going to try and make use of, as I said, I'm going to use just two methods. For today, we are going to focus so much on the top down, which is simpler because you basically use the market, the price and cost, and then the rest of the things fall in place. So I'm going to use that logic to help everybody be together when it comes to the income statement. Then we can modify for those ones who want to go a little bit further. And then for those ones who have past records, we shall help you project, but based on the compound annual growth rate. Don't worry about the technical jargon. The most important thing is applicability. All right, let's take the break. Thank you very much. Yeah. Alex, I can pick your question as we still have like 2 more minutes as people are taking the break, just in case it was a question. Happy to attempt to it. Did you have a question? Alex? All right. All right. All right. Alex, do you have a question before we proceed? Are you there? You've muted. All right, I'm going to proceed. All right, 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 all right. Okay, back to our, Alex, your hand is up, so I'm not so sure if it was on before or it is on now, or you may need to help me clarify. But I beg to proceed. Can I see a thumbs up if I can proceed? Are people back? Thank you, thank you, thank you, thank you, thank you for those who are agreeing to proceed. All right. So I want to believe we are all familiar with the profit and loss and income statement. And maybe just to summarize, for you to know your break-even point, you need to know your fixed costs or your fixed cost, your price, and the variable cost. That's all you need to calculate your break-even. And when you calculate the number of units, you divide by the time it takes for you to produce or to sell those units, and that will give you the break-even point in terms of time. So usually the fixed cost can be the amount of money you need. So you can say, oh, I am looking for $150,000. I should be able to break even in the next 12 months, okay? Basically, the logic is the amount of money you're asking is fixed. So the price of your product or your margin, in other words, you don't need to subtract price minus, but you can as well say that amount divided by the profit per unit should be equivalent to your break-even point. That summarizes that. Okay, so we are going to go through the three statements, the three common financial statements. We have the income statement, the balance sheet, and the cash flow. Hold on a second. Let me just use, share also something with this. All right. Let me share this. All right. So you know that we have three statements: the income statement, the balance sheet, and the cash flow statement. And the income statement is basically a representation of revenue less expenses, and that gives you your net income. The balance sheet gives you assets, uses assets is equals to liabilities plus shareholders or stockholders equity. And cash flow is basically the change in cash. Okay, so these are the common financial statements. When we ask, can you give us your management account? Sometimes the entrepreneurs are asked, can you give us your management accounts? And somebody wonders, okay, what are management accounts? We are basically asking you for your income statement, your balance sheet, and your cash flow statement. Okay, now, when we even do our financial planning, we plan using these statements, the income statement or the profit and loss, some of you call it that, balance sheet and cash flow. So this basically represents the statements in a bird's eye view. Revenue minus expenses gives you net income. Assets is equal to liabilities plus stockholders equity, while cash flow is that. You don't need to really cram. These are done by you always find you have an accountant or you have QuickBooks which generates for you. What we are going to focus on a little bit more is projecting ahead, and for those ones who probably do not have some of these numbers that fill in to come to an income statement, we're going to derive one or two just for you to have an insight, okay? So for that to happen, let me just introduce you at least the income statement by structure. I know you are aware, but just for the interest of everybody, I'm going to show this again. Sorry. Yeah. All right, let me share. Okay, so a typical income statement looks like this. And I'm going to emphasize a little bit more because this brings out the performance of the business. The income statement really is about the performance of the business. Now, you'll find at point A, we have revenue minus cost of goods sold. In others, we are basically telling you revenue minus the cost, the variable cost, the total, which gives you the gross margin or the gross profit. Then when you remove, these are operational, mostly operational expenses, service expenses, human resource, things like salaries, those are fixed, okay? Salaries are different from wages. Then marketing expenses, if you are doing promotions, printing, those things. Overhead expenses, call this selling, general, and administration, okay? It's basically all overhead expenses, okay? When you subtract these operational expenses, it gives us what we call EBITDA, earnings before interest, taxes, depreciation, amortization. This is a very, very important factor. And you'll always find you're going to see a lot of investors saying, I want the EBITDA margin. I'm looking for companies that have an EBITDA of 100 million, or I'm looking for companies that have an EBITDA of 50 million. This is basically what they mean. When we remove operational expenses from gross margin, that is the percentage. That is the amount they are looking for. Okay, so if you fall in that category, maybe people who have an EBITDA of 10 million or 5 million or 2 million, that is basically what it means. Then EBITDA minus depreciation gives you earnings before interest and taxes. That is EBIT. Then when you remove, if you have a loan and you have interest that you are paying, if you remove the interest, you remain with earnings before taxes. Then when you remove the taxes, you have profit. So this is the order on this is the flow. Okay, you don't need to cram the flow because this is a standard, and for the templates we share, you'll find that is really the standard that it flows. So you don't need to. Okay, so now we are going to go into from a simplistic perspective to fairly complicated, and I'm going to make use of simple Excel templates that I've created prior to this. And we shall share. I'm just going to see what I'm going to share. Okay, so I'm going to use financial trees. Let me see, I'm going to use financial trees for product and service. Then from the financial tree, I'll extend to make a simple financial model. So let's look at a financial tree on a simplistic level. So a financial tree basically looks at your business on a very simplistic level. And I thought of making use of this just because some people may not have the details, but at least have the numbers. So this is how a financial tree looks like. Has somebody ever seen this before? Anybody ever seen this? So I'm introducing you to the simple logic that you can use. So for example, in this financial tree, let me just see behind here. Okay. So in this financial tree, we ask you, let me start with the one of product, then I'll go with the one of service. Sorry. Let me start with the one of product, then service, not the other way around, so that we are all on the same page. Okay. Okay, let me share again my screen. Has this disappeared? Okay, let me look for it. Come on, where is it? And so many templates. Let me just see where it is again. Financials for product template. Okay, yeah, finally it is appearing. Okay, let me see. Okay, perfect. So we have this of product. Let me look at, let me bring it. Okay, so for those ones who are doing product, this is basic logic, and we're going to use the logic to now go into the financials. You'll see how I come from this into the main thing. So I can look at, for those ones who have products or who make products. So we look at what is the life of the customer. Now, life of the customer is not their their life, real life, but the time it takes for them being loyal to you or in your business. So for example, a customer remains loyal probably for a year. I'm going to use the assumption of a year, okay? If you are sure of more than a year, feel free. So I'll say it's 1. Are you seeing what I feel? I'm only feeling what is in blue. What is in black will be computed. So life of customer, I've put 1 because I'm sure within 1 year they'll be committed. Beyond, they may not. Then life of product. So I will assume, for example, I am dealing with which product? A product that is used monthly. So that means every month they will buy from me. So I will say the life of product is, because you are seeing there in brackets in years, every month will be 1 divided by 12. Huh? Is it? I want you to follow kindly. So that will be 1 divided by 12. And that comes to 0.83. 0.083. Okay. Okay, so basically, as you can see in black here, it has come. It has brought, let me use my pen. I put 0.83 here, and it has brought for me 12 times. That means the customer will buy 12 times. In other words, every month. Okay, then how many products does this customer buy every time they come to buy from me? I'll say 1. It could be they buy 2. So in your case, if they buy 2, you just put 2. Okay, products per deal. A deal is any transaction you interface with the client. Okay, so if they buy 1 product every time I interface with them, that means at the end of the year, they will have bought 12 products. Okay, and that's why you can see in my slide here, products per customer per year is 12. Then it asks you a very simple question. How much does it cost you to sell to a customer? For example, if you had a marketing budget, can you break it down in what is the cost of getting 1 customer or selling to a customer? So maybe I spend 6,000 to get 1 customer. It could be more, it could be less. When I put that figure, 6,000, it will tell me that if I spend 6,000 to get 1 customer, that means I spend 498 to sell 1 product, because a customer buys 12 products. Okay. Now, how much does it cost me to make 1 product? 1 product, that is the variable cost per unit. How much does it cost me to make 1 product? I can say here it costs me 5,000. So that means if I sell 498, if the cost of making 1 product is 5,000, cost to make per product is 5,000, and the cost to sell each product is 498. So my cost per product, now if I put the cost together, the cost of making and the cost of selling, I put them together, and that brings me the cost of each product. Now, if I put the price per product, it will basically give me the profit per product. And here now, all I need to do is, I am targeting 1,000 of these customers, or 500 or 200. So if I say this market in Kampala, I have, say, let me clear first and type something. Maybe I say here in Kampala where I'm targeting, I think I have Kampala has over 500,000 potential customers. But I'm going to target only 2% of this market. So 2% is 100,000. Maybe I'm targeting 0.05%. Sorry, I didn't put the right. I was supposed to put 0.05. it will give me 250 customers. Okay, so these 250 customers, remember how many products a customer buys in a year? Okay, so products the customers will buy in a year is 30,120, and profit per product is 14,502. So products per year times profit per product gives you the amount of money you'll make in a year. This is a financial tree. Some people like it that way because it helps them basically articulate the business in a very simplistic manner, while some look at it complicated. But I thought at least I show you one of the ways you can use. Now, the only challenge with this is you can only articulate it for 1 year, okay? Now, once you develop it for a year, we can develop a financial forecast, okay? So I can use the same logic here. I don't know if I'm showing if all of you can see the logic. I can say, now this is the market share, okay? My target market is 1,000, okay? The products per deal is 1, deals per customer per year is maybe 1 or 2. So when I put the same assumptions, and I can put and say this is year 1, year 2, okay? So it will easily project and still give me a profit, an income statement. But this is the very bare simplistic income statement. But logic, it's very logical, and still somebody can articulate it to somebody. Any questions on this? For those ones who like this, we are happy to share, but it bases on basically simplistic approach, where we look at the life of the customer in terms of how long they remain faithful or committed to my business. How many products do they buy in a year? Maybe 1, twice, you get. So once you put that figure and we ask, how much does it cost you to sell to a customer? Then how much does it cost you to make? Then the rest, it just computes for you automatically. Now, using that logic, you can now say, okay, in year 1, now in year 2, this is how it's going to be. Maybe I will increase the number of customers, and then you can add fixed costs, things like rent, you can now add down and now make it just a fulfilling income statement. Anybody with a question on this? Do you find this interesting? Okay. Can I go to another version? So that is one, you can use a financial tree, and a financial tree for a product is different from a service. So for those who will be interested in financial trees, I'm happy to share so that you can fill in and use it as a basis of logic, okay? All right, any question? I need this. Nicholas, okay. Yeah, okay, that is noted, Nicholas. All right. Anybody with a question? We've just basically used a financial tree. And as you've seen, it looks at units. What is how long does a customer remain committed? How many, how long does my product last before a customer buys? Maybe it's a month, maybe it's when I feed in those data, the rest just flows in. Okay, that's one. Let's go to another. Ladies and gentlemen, I'm just going through different approaches. As you can see, you can articulate your finances in very simplistic ways, so you don't need to fear financials anymore. I hope from this time onwards, you'll be able to see that financials are fairly simple enough and achievable. I'm going to share another. Okay. Just going, for those ones who have figures, we have this, where you will simply fill in, your revenue 2018, 2019, 2020, 2021, we can extend. Then you just fill in the blanks. For example, I put maybe the cost of goods sold. This is 200, whatever. And that gives me 20 million. Then I put my marketing costs. I put this 45. My staff cost, maybe I did 3. You just fill in the blank spaces, my dear colleagues. If you have the numbers, the rest, it will just give you the details, as you can see, okay? And you just go with the flow. You will see EBITDA is here. EBITDA is already provided here. Depreciation, if you have earnings. So for those ones who have had financial statements for the year or have worked with accountants, you just feed in, because most of these records, chances are you may have, okay? So that is another. I don't think there is need for question here, because this is basically pretty much simple to fill in. I don't think there is much logic. And once you fill in the blanks, it will fill in the rest of the things, and your income statement, balance sheet, and cash flow will be as direct. Okay? If somebody has a question on this, as I said, it's quite direct. So this one just looks at the financials, and then you can put projections. Okay? There, you know, ideally in financial modeling, we normally don't like putting a lot of different, we weight them. But there are those like Mr. Godfrey who has several products and you want to put each of them. This template can as well work for you, okay, where you can project ahead. So for those ones who are interested, as I've said, these are for you. Unless somebody wants to know any specific item, but they are pretty much the same. As long as you have your numbers, you can fill them in and it can be able to calculate for you the projections. Now, we are going to share this so that you can have these numbers. And I would recommend, actually for today, we are going to share this immediately after our session so that tomorrow you can fill in today. Tomorrow we can have a discussion, but I will be going a bit deeper in terms of projections. But using other ways here with projections, you're just putting based on your thoughts, but usually we don't use thoughts, okay? But you can as well use this template for those ones who probably have a predefined idea, okay? That's done. If there's any question, I'm happy to answer. Now, I am going to pay a bit more of attention on a more standard use case. Let me just confirm what I'm going to share. Sorry, just a second. I need to follow up on something.
Hi, Roy. Your microphone is muted. We can't hear you.
Yes. Can you hear me now? I hope was it muted for very long?
From the time you came back.
Hey, sorry. That was, I think that was a few minutes. Okay. So as I've said, we're going to share with you options. We're going to share with you options and evaluate what works for you for now. Because some of you have numbers, some actually don't have, okay? But what I will pay a bit more of attention tomorrow is the projection, okay? Once you have your things in place. So, and on the projection, there are a number of, I want to get an empty one. Yeah, so that you can see, okay, let me just share this. Though it was not for this session. Okay. All right. Okay. So for now, ladies and gentlemen, this is how we'll want you to develop your financials. And I'm going to start. I hope you can all see my screen. So I'm going to use, Alex, what's the name of your company, sir? Is Alex there? Alex, you've muted. Okay, I know it's some hospital. Is it a pharmacy or hospital? So I'll say Alex Pharmacy. Okay, financial model. Email alex@gmail.com. Okay, I want you to develop fairly standard. That's why I'm trying to take us through this. 04, maybe because you are international, you may be discussing with an international investor. Okay, website, Alex Pharmacy.com. Okay, so that is, I'll fill that. I can put, okay, drugs and medicine. What else here is this? Drugs and medicine consultation. Huh? Problem, health diagnosis. And then I can do, what else is this? Health diagnosis. Then I can also do laboratory services. Okay. Now the products I put here, we expect to see the revenues. So I can as well say, okay, now I have for some, if you want to do weighted, I'll say drugs and medicine, health and diagnosis, laboratory services. I'll put drugs, medicine. What was the second one? Health diagnosis. Health diagnosis. The third one is what? Laboratory services. Laboratory services. Okay. So yeah, usually the price varies, but maybe there's a standard. Yeah, it's higher or lower, but yeah, can say maybe standard for drugs on average we sell each at maybe 30K. Health diagnosis, on average we sell, we diagnose at 10K, and yeah, that was 10K. And laboratory services we offer at maybe 20K. All right. Then I can say, okay, so depending on, since I don't know the percentages, I may not know the percentages, but I can say for medicine, I sell about 500 of those. I do about 200 diagnosis, and I do about 100. So it will already compute for you the percentage and the weighted average. So I just need to put the variable cost. As you can see, we've already embedded, so you just fill it. So there you don't need to cram, oh, break even point, what? No, okay, so drugs and medicine, that is, what is this? I can say the variable cost, if I do 30, maybe it's 15. Health diagnosis, maybe 5K. Laboratory, maybe 10K. Okay, so it will give me my weighted price and my weighted variable unit. Okay, and yeah, using these details, let me just see if I can circle them. Using these details, okay, instead of saying I do drugs, what, I can just pick this. So there are some people who prefer using weighted. There are some people who prefer putting drugs and medicine. We did this. Either way, it is fine, ladies and gentlemen. It's just what works. But for financial modeling, we prefer weighing because it's technically simpler, because some people do not want to go so much insights into. Okay. So once you get the unit costs, you can go on financials and now simply put, okay, so how many customers am I targeting? Maybe in 2018, I had 200, 300, just filling. Life of customer, obviously, how long will they remain committed? Okay, so if it is half a year, you'll put 0.5. But if it is 1 year, you put 1, depending on your assumption. Then duration of use, how frequent do they come? Maybe they come 3 times a year, so I'll put 3 out of 12. And that is what you are going to see here. Then this, whatever is in black, you don't need to touch because it computes. Product per customer, okay? So for any product, does the customer come once when they buy, or they buy, do they buy one product or several products when they come? Maybe they buy 2 products every time they come. So I'll put 2, and that will say that in every year, on this year 1, 2018, each customer bought 8 products from me. Then what is the cost of selling? Or because usually I have a marketing budget, or I promote my product, so I spend some money. So what is the cost of getting or selling to each customer? Maybe I'll say the cost is 5,000. Sorry, 5,000. Whatever is in blue is what I feel. Whatever is in black, it computes. So that means the cost of selling each product is 625, because for each customer I get at 5K, they buy 8 products. So that means the cost of selling each product is 625. Imagine that insight. You tell investors, you know what, it costs me, I spent 625 shillings to sell my product. Then how much does it cost you to make each product? Or for those ones who trade, you can say, how much does it cost you to have your product in your store? Plus the buying price. Maybe it costs me, let me put a figure that can be 6,000. Okay. Okay. So that means the cost, my cost per product is 6,625. Now, the products I sold in that year, 1,600, because I targeted 200 customers, each buying 8 products. And then what is my price per product? Now, when I do my price and say, okay, each price I sell each product at an average of, what unit cost did we put? Let me use the unit cost that we found here. So I'll say my price is 26,842. So I'll put 26,842, and the cost here I can put 13,421. 13,421. 13,421, because that's the variable cost per unit. So it will give me those numbers. Then I'll need to make some assumption. So I can say my operational expenses, rent, what, I can put a percentage of revenue, or I can just put the figures. themselves. Once I put that, then I can as well say my depreciation is a percentage of the property I have. So I can put these are assumptions that I just make. Then if I'm going to get in a loan, or I've been getting a loan, I've been getting a loan at maybe 21%. So I put the 21%. If I have a loan, if you don't have, you just put 0, because it means you don't have a loan. But if you do, you put the percentage. Tax, that one does not change. URA has already told us that is 30% income tax or corporate tax. Okay, so all you'll need to do, ignore the balance sheet assumptions. The moment you feed in all that data, it will generate for you a very nice looking income statement. It will show you your gross margin. It will show you your EBITDA. It will show you, yeah. So I beg to receive questions. I don't know if this is simple, but I've tried to make it simple, but I'm equally open to listening based on what I have shared. What works for you? What would you want us to share with you? Thank you. I'll receive questions, feedback, comments. Yeah, tomorrow we shall extend on projections, how we project, and know the ratios and what they mean in our business, and also extend to valuation. But at this point, I just wanted us to know how to make our income statement. Any questions? Dennis, Rona, Sheila, Emmanuel, Alex. Alex, you are an accountant, so I don't know if we've simplified or have made it complex, but feel free to comment, sir. Sheila, you have a question.
I don't really have a question, but out of my observations, of course, you've done a lot of product-based projections and explanations. I hope that you'll be able to also do service-based, knowing the business that I am in, because some of those things, of course, aside from variables, even our cost of products are quite vary. They're not as standardized as those of product-based companies, yeah? Mm. So I'm following, but I still have some questions.
For the benefit of Sheila, okay, there are two things I'm going to emphasize. And for the benefit of Sheila, I am going to give an example. And I'm going to give our own example as Imuka, because we've just recently, by the way, as you fundraise, we're also on the same block. So I totally get an insight in terms of everything we go through and we pitch frequently. So I'm going to use something that I just worked on recently for Imuka. But before I do that, I just want to probably, because I've talked about the templates, and I would just simply want at least to have a bit of, I would recommend for, I know I didn't pay a bit of attention here, but I'm just going to mention it because it's fairly direct. These are balance sheet assumptions. Now here, receivable days are days it takes for you to receive money. For example, if you give goods on credit, on average, how long does it take for them to give you your products? Okay, so here it is indicating 45. Or you are indicating 45. Now, for those ones who don't know, I've left it in blue. But for those ones who have numbers, if you find this in black, it means you just fill in the numbers below. How am I going to do that? Because we have different scenarios. Okay, let me just ask by a show of hands. How many have numbers clearly in their business, like they are certain about the numbers of the past years? Because that determines what we can share. And those ones who don't have numbers, Okay, let me start. How many have numbers? So that we know what we can share. How many have numbers? Like you have your numbers? Yes, okay. Ruth, Nicholas, you have your numbers. Emmanuel, do you have your numbers? Angela, Dennis, Jesse, Godfrey, Mildred, Okello, Rona, because it helps us know what we need to share with you. Okay, the rest, you don't have numbers. So you need to sort of work backwards. Eh? Okay, oh, most of us have numbers. Okay, that makes our work a bit easier. Oh, perfect, perfect. Looks like most of us have numbers. You've even made my work now a bit easier. Hey, I was a bit worried now. Should we just use projections from the past and the future? But now, since you have numbers, I'm going to recommend us to proceed with let me just share this. Where is this? Yeah, okay. So I'm going to use this three-statement model for use. Let me share my screen and explain it a bit before I go on responding to Sheila. Okay, so ladies and gentlemen, this is a typical financial statement. Okay. Now, as you can see here, it is in black. Whatever you are seeing in black, you do not need to type. Why? It is formula driven. Whatever you are seeing in blue, we are going to do that tomorrow, how to develop projections, because these are years ahead. These are projections. The years back, because you have numbers, you don't need to even to worry about the assumptions, okay? All you need to do is fill in your numbers down here, okay? You fill in your revenue, you fill in your cost of goods, okay? It will calculate the profit. You fill in your salaries and other overhead expenses, okay? It will calculate the total expenses, then calculate your EBITDA. Now, I'm going to share one that is more standardized with EBITDA and the other things, because I want us to have EBITDA margins and the others. All I need you to do is you fill at the blue section, whatever is in blue, and it will help us generate the assumptions in black, okay? So once we have the assumptions in black, tomorrow we shall do projection, okay? And the projections we are going to do will be based on what we've come out, what came out of our past years, okay? I hope that is clear. All you need to fill in is the blue, sorry, because we do color coding. Eh? Anything that is not formula driven is in blue, okay, in principle, okay, in terms of the financials that we do, and what is in black has been generated by a formula. So you'll notice here in blue, you just put it, you just fix it, and then what is in black is calculated by formula. And you'll notice now, for example, on top here, on top, we have the assumptions are derived, but below there, we have hard coded the numbers. While in the future years, we've projected the assumptions basing on the past, and the numbers are now automatically computed. So ideally, that's how we shall go about the projections. And once we do the projections, we shall be able to do examples of how we come up with the value of your business using the income approach and the market approach. And I'll also explain a bit of the cost approach. Okay, that was it about financial statements. So if you have your numbers, I'm really glad, because that makes our work easier in terms of what we shall share with you. So we shall share one that you need to fill in the numbers, then it will develop the assumptions, and tomorrow we shall use the assumptions to generate the future projections and the numbers. Also keeping in mind what you want to invest. So if you want equity, you'll put the figure you want in equity, debt. So all that we shall show you. Okay, that's one. Now for Sheila's case, I'm going to share a financial model that I worked on recently for Imuka, because we were submitting to an organization for support. So as you can see, this is Imuka Access. This is our model. and it typically stipulates. Now, Sheila, products and services, trainings and master classes, target customer, entrepreneur, revenue stream, participation fee, tailored business development support. These are personalized support services, and we support entrepreneurs with fellow experts, and there's a handling fee and affiliate fees. Then deal sourcing or supporting investors in getting entrepreneurs who are suitable, maybe finder's fees, investor linkages, success fees, project management for organizations that want, okay? So that has been structured. Then we make assumptions. Okay, so here we made assumptions in terms of, okay, if we are doing, say, trainings, okay, what are the numbers, okay, for each year? And then what is the cost? So we put the assumptions. Once we put the assumptions, then I simply transfer that on the financial model. And that's why you can see here, I had put weighted cost, but they requested that I open up the different products and services. And that's why you are seeing it separated this way. Okay, so I hope now you've seen you are not alone. We are all doing the same. So Sheila, I hope you can see that you can actually do that. It's as long as you know what your product line or service lines. Some are futuristic because you may have a product, maybe you're not charging, but probably something will charge in the future, but it has to be deliberate that, okay, this is what I'm doing, these are my numbers, because you cannot articulate anything without your numbers and say that it is sustainable. Questions? Can I get feedback? I don't know how this session has been. Usually whenever I'm planning to do financials, you really think, because you don't want it to be complicated, you want it to be really simple. So I want to hear from everybody. What have you got from today's session? Starting with Rona, what is your take home today? And I can as well stop recording.